for tonight. This is a semi-annual CIE financial seminar. I'm not sure that everybody speaks Chinese, so I'm going to use English. Once in a while, we might say Chinese. So the flow will be like this. First, I'm going to introduce Jonathan Chen. He's CIE president this year, so he will give a CIE introduction in 2-3 minutes. And then we have a great speaker team, Geneva and Ed from Capital Group. So we're going to introduce them. Geneva will probably say more about Ed, but both of them are very senior financial professional, deal with a lot of money, a lot of assets management. So we're happy to have them tonight. But before we start, we'll let Jonathan briefly introduce CIE, and then we'll come to the real thing. Okay, Jonathan, please.
Sure, thank you, JP. My cat said, bite me. Good morning, everyone. I'm Jonathan. On behalf of CIE, I am here to give a brief introduction about the CIE. CIE was founded in Cornell University in 1917, 105 years ago. Besides our chapter, CIE has a chapter in New York, Seattle, Dallas, New Mexico, and Southern California. All chapters work together closely. Besides that, we have 3 national, international events like AEOY, Asian American Engineer of the Year Award, was held in USA every year since 20 years ago. We also have the MATS and the SETAC were held in Taiwan and China every 2 years since 1966 and 1993. Our chapter was founded 43 years ago in 1979 as a nonprofit organization with serving engineers, scientists, and the students in the San Francisco Bay Area Bay Area community. In 2020 to 21, our chapter hosted the AEOY conference and ceremony. We had Jason Huang, and NVIDIA, the founder, and AT&T CEO Ann Chow join us together. Since during the pandemics, we moved everything to the online. We live streamed the ceremony online with over 5,000 views. We also have the career fair and the carnival. We received more than 1,000 applicants. We opened 13 Zoom meetings at the same time, and each meeting has several breakout rooms. So it's quite impressive for that one. It's 2022 and 21. For the 2021 to 22, it's a virtual year, but we never stop our steps. We moved everything to online. We have many events, average like 2 weeks, one event. And then this year in May 2022, finally we have the first large-scale in-person event since the pandemic in the Bay Area Chinese engineering community. We're honored to have the California State Controller Betty Yi as our keynote speaker, and IEEE 2024 President Dr. Coughlin as our featured speakers in the afternoon. So we have the conference, dinner banquet, Entrepreneur of the Year Award, and the high school scholarship all together in that annual conference. We have more than 60 volunteers work together to make it happen. It would not be possible without the support of volunteers and also our sponsors. So thank you very much.
Okay, thank you, Jonathan.
Not yet. Let me just give you 1 more minute to finish it. In the since the 2022 Q3, we have a lot of events. You can see from the September, from the summer, and September and October, we have barbecue, crypto event, healthcare, and the blockchain photonics and AI machine learning hiking. And November, December this year, we have a more event. You can take a look. So besides that, we have a coding study group meeting every Saturday. So since the pandemic, it's over 90 meetings. So we have a heritage, technology-driven, cross-culture, next-generation volunteers, work-life balance. CIE brings a positive impact to the Taiwanese and Chinese American engineering community. So if you'd like to join us, let me just snapshot this one and to sign up with newsletters or contact us. Okay, thank you. Back to JP.
Hey, in case you're coming late, my name is JP Li Zhaoping. I'm helping CIE to host this financial seminar. This is what we do once a year or twice a year thing. A little bit background with this is that we joke about is the Chinese engineer tend to be good, but we not tend to be good on money management or assets management. So during the network, I think that Geneva and Ed have been very, very experienced in this area. So we're very happy to help them to give us a talk and a thought on how do we manage and survive this downturn better. Some logistic question on this is that if you have any question, please enter in the chat room, and volunteer Yan Su or Angela, we gather all the question. Or when Ed has paused and ask you any question, you can say that there, and Ed will try to answer that. But let me get into the real thing and introduce Geneva and Junia and Ed to be the speaker. Junia is a very interesting person. You will learn she's so smart. She grew up in Bolivia. You know, most of the overseas Chinese and can speak 5 or 6 different languages like her. She speaks Mandarin, Cantonese, Spanish, English, and most of them also speak Hakka or Hokkien. So she went to Europe for further master degree. So I bet you can say bonjour or guten tag or additional language with her, and she probably understand that. And she came to US and be a financial professional. She didn't look like she had more than 15, 20 years experience, but both she and Ed had a lot of experience on this. So we are very happy to help them to guide us. How do we safeguard our fortune, our money? How do we diversify our portfolio in this bad time? And she can say more about Ed. You would like her, like his talk and his marine background. So with that, I will turn the floor to both of them. That Junia to say about what they are and introduce Ed, and then get into a real presentation.
Thank you so much, JP and Jonathan. I know you guys for quite some times now, and I truly appreciate your friendship and your collaborations with us and with me especially. Being a corporate sponsor to the CIE, and I got to be very careful when I say CIE because I don't want to say CIA. I was warned about that. So thank you so much, CIE and Jonathan and Raymond before, and also JP for having us today. We are a corporate sponsor to the CIE. We love our community, and that's why we're here to give back to the people that we love and we serve with some educational programs so that our audience, our community can benefit from what's going on in today's world. Again, my name is Junia. I, again, was born in South America, in Bolivia. I'm Chinese, 100%, no mixed. I can speak quite a few languages on top of what I was mentioned about French and Germans and, you know, all the additional languages that, you know, you can probably practice it with me in an off time. But today we're here to talk about some financial educational programs for you. That's why I have my colleague here at Gonzalez to do the presentation with us. Just to give you a little bit of background of Ed Gonzalez, well, thank you, Ed, for your service. He has been an ex-officer at the Marine Corps in the US. So he's very experienced. He loved to talk to people about numbers and, very bullet point presentations. So you guys are gonna love him. Prior to joining Capital Group, he was a senior investment strategist at Wells Fargo Private Bank. And before that, he was getting his MBA from UCLA, and he's also hosting his CFA designation. He's very well qualified to talk to us about financial market with today's downturn. What is there to present to us as opportunities, and how do we diversify into a better portfolio for us to have better fortune in the future? So with that, Ed, I'm gonna have you take it away for today's presentation, and then after that, we're gonna have some Q&A session so that we can have interactions with you with the topics that you're gonna guide us through.
Absolutely.
So why don't you take it away?
Junia, thank you so much. Thank you so much for that very kind introduction. And it's a real pleasure to be here, and I'm very excited to walk everyone through what we're going to be talking about. So with that, what I'm going to do now is I'm going to attempt to share my screen. And let's see if we can get this up on the board. Very good. And I'm just going to make it a little bit bigger here. And hopefully now we can all see that.
Yeah, I can see it.
Perfect. Investment planning, diversification, and the role of alternative investments. So in chatting with everyone before we came here today, this is a really interesting group, and it sounds like a lot of you have some really interesting and amazing careers. But through your careers, you have accumulated some stock for the companies that you worked for. So I have heard that many of you have some concentrated stock positions in companies that you have worked for in the past. Maybe it's one big position, maybe it's part of a startup, or maybe it's if it's just a few companies, maybe 3 or 4 companies that you've worked with in the past. And the reason that I, number one, want to talk about diversification is that no matter how good we think companies are, sometimes companies have problems. Sometimes they struggle, and sometimes they fail. They can be for a number of different reasons that are outside of our control. Sometimes within companies, there could be fraud. Sometimes it could be fading demand or old products that are becoming obsolete. Other times there's bad management decisions. There can be environmental problems, regulatory risk and regulatory actions where the government steps in and changes the landscape of the business can sometimes have devastating effects on companies. And other times there may be sometimes unsound financials. The one that I like to personally bring up, I'm not sure how long many of you have been inside the United States, but when I was growing up, Blockbuster Video was a main part of my childhood. We used to go there every Thursday and Friday night. Everyone went to Blockbuster to buy their videos for the weekend. And with Netflix coming on the scene, and now the other all streaming services, that has changed. The other one was Kodak disposable cameras. Before the iPhone, anytime you were going on a trip, you had something fun to do with friends. I know when I was a high school student or a college student, if I was going to do something fun, I would go to the store, buy a few disposable cameras to put in my backpack so I would have them with me to take pictures. So there's a lot of different reasons. So we know we don't want to hold just one company, but the stock market can still be risky. And I know this is a group of engineers, and I'm a chartered financial analyst, so I like numbers and data. So I wanted to make sure that I don't share this with all the groups. I wanted to bring some data with me here today. And to me, this is one really interesting piece of data. This is the stock market. This is almost 100 years of data. So this starts in 1926, and it goes all the way to the end of 2021. So what is this showing us? This is specifically the US stock market, all the companies in the US stock market. So here we have 1-year returns. So here, what we're going to look at is every single year between 1926 and 2021, and we're going to pretend that we'll close our eyes and we will pick a year at random to invest. And if we pick a year at random, what is the chance that we could potentially make money in the stock market or lose money in the stock market? And this is if we are hypothetically investing in an index, we're investing in everything. Well, on any given random 1 year period, there is a 74% chance that we might make money. On any given year for over this past almost 100 years, there's a 26% chance that we could potentially lose money. So the odds are already good. If you're a long-term investor and you're thinking about the next 10 years, 15, 20 years, 76% odds of making money is already pretty good. However, we know the trend is up for the stock market, that over the long term, there's ups and downs, the trend leads up. So what other data points do we have? Well, here we have a 5-year rolling return. What does this mean? This means that we assume you hold your money in the stock market for at least 5 years. So we're looking at 1926 to 1931, or we're looking at 1975 to 1980, and all of the different 5-year chunks of time throughout this very long period of time. So if we assume that, and we know the trend is up, all of a sudden, the probability over this time period of making money in those 5 years increases to 87%. And the possibility in periods that have lost money is 13%. If we extend our time horizon higher to 10 years, so now we're looking at 1926 to 36, or 1975 to 85, or 2000 to 2010, the periods that have gained and made money was over 95%. And finally, if we look at 15-year rolling returns going back to 1926, there has never been a 15-year period where the stock market has lost money. A diversified pool of stocks in the US have lost money. So point number one, when we think about diversification, there is still going to be downturns. On any given year, we should expect there's about a 26% chance on any given random year that we could be down and lose money. However, riding this out and extending our time horizon increases the chance that you will grow your wealth. That is one of the most important things to understand about investing in stocks and a diversified stock to begin with. As we move forward, we want to think about ways to diversify. And the simplest way to diversify to begin with is with stocks and bonds. So we're going to start with these two things. We'll add more as we go into this presentation, but we're going to start with just these two. So we have stocks and we have bonds. So in front of you, this line right here, this is called, for investors, the efficient frontier. Within it, there's an equation called the Sharpe ratio. It is part of a larger body of work that's referred to as modern portfolio theory. I'm not going to go into all of it, but I want everyone on this call to know the Sharpe ratio and the efficient frontier and much of this has won a Nobel Prize. So there is a lot of research to back up what I'm going to show you. So what does the efficient frontier tell us? What it shows us is over here we have a 100% allocation to bonds, and over here 100% allocation to stocks. Bonds are considered less risky, stocks are considered more risky. If you want to make more money, if you're excited about making more money and potentially want to make more, you have to be willing to accept more risk. So what is this graph that we're looking at? On the vertical axis, we're looking at returns. What is your expected return? How much money do you think you're going to make? On the horizontal axis, we have risk on any given year. As we move farther out to the right, we are taking more risk on any given 1 year period. So as you see, if you want to make more money, you have to be willing to accept more risk. Here's the big warning that I give to everyone. And we saw this a lot last year with initial coin offerings, with NFTs. You will have people that will come to you and they will tell you they have this investment right here. You're going to make a ton of money and take no risk. We're going to double your money in 18 months or less, guaranteed, maybe even more than that. My big message to everyone on the call today, when you meet someone who tells you that they have that kind of investment, you should take your hand, cover your wallet, turn, and run away because they're either a con man or an idiot. Those investments do not exist. They will never exist. There are investments out there where you could potentially make a lot of money quickly. But if the potential to make that money is there, there's an equal possibility that you could lose everything. Those are very, very risky investments. And so we're going to talk today about less risky investments, ones that will go up and down over time, up and down on any given year, but do very, very well over time. So I just wanted to clear that as well. Okay, that's the theory. My engineers here on the phone, let's get into a little bit more data, just with stocks and bonds. So in front of you here, I have 52 years of data. This is the efficient frontier in reality. Here, oh, and I wanted to tell everyone, I've gotten all these approved. I'm going to send all of these to you afterwards. So you're going to get all of these slides in your inbox when we're done. They're all approved, so you'll be able to have these in PDF form yourself. So the theory is the efficient frontier. Let's talk about how it's worked out at least over the last 52 years. Here, we have a 100% allocation to bonds. Over on the right-hand side, we have a 100% allocation to the stock market. And then we have the different percentages in between, 20% stocks, 80% bonds, 80% stocks, 20% bonds. Let's take a look just right here. Let's take a look at what many people in retirement think about, 60% stocks, 40% bonds. Many people consider this to be a very middle of the road portfolio. If you invested a certain amount of money, January 1970, and held to the end of 2021, you would have earned, on average, 9.9%. That is what your return have been. But we know it goes up and down. What is the worst case scenario? What was the single worst year on record over the last 52 years? Negative 29.9%. The best year was 47.5, but there was your average. But now we go into probabilities. How many times, how many of these months, the percentage, was it making money? It was making money 85% of the time, and it lost money about 15% of the time. But if you ride the ups and downs and you have a long time horizon, you make money over the long term. What this shows, and what I want everyone to think about as you're thinking about your own portfolio, is that if you have diversified stocks and you add in bonds, you can think about how risky do I want to be? The safest portfolio out there, it makes the least amount of money, but is the safest over the last 52 years, 80% in bonds, 20% in stocks. The worst case going to 2021 was about a negative 8% return, but it was making money 94% of the time. So this is considered to be kind of the safest portfolio. Now, I'm going to show you one more slide when it comes to stocks and bonds, and then we're going to move on to other things. But this next slide, I think, is very, very important because all of these best case, worst case scenarios are all just 1 year periods. And I've said before, we want to invest for more than just 1 year. We should be long-term investors. You should be thinking about the next 5 years, 10 years, 20, 30 years of your life if you're young, and all about your retirement. So how should we think about that? Do we have data? Well, I have more data for you. This is a very busy slide, but I promise I'm going to explain it to you all. This slide right here is the exact same slide as this one. It's 52 years of data. So it starts in 1970 and goes to 2021. So this is 52 years. Here we have 100% allocation to bonds. Over here, we have a 100% allocation to the stock market, just like on this slide. Now, we have more bars. The dark blue bars are the same numbers that we saw on the last page. They are 1 year returns. So look at 60% stocks, 40% bonds. We have 47.5, 9.9, negative 29.9. 60% stocks, 47.5, 9.9, negative 29.9. So the dark blue bars are the same that we just saw. But you remember when we were talking about equities earlier, I showed you how 5-year chunks of time the stock market goes up more times, or 10-year chunks of time. We're now going to do the exact same thing with the data, but we're going to add in bonds. So here we have 60% stocks, 40% bonds, and we're going to look at our 5-year holding period, 5-year rolling returns. That's the light blue bar. You'll notice that the average return is very similar, so a little over 9%, close to 9.5%. But your worst case scenario, worst case over the last 52 years, goes from negative 29.9 to positive 0.2%. This allocation never lost money over a 5-year holding period over the last 52 years. If we extend our time horizon to 10 years, that's the green. Again, your average return is very similar, but your worst case scenario goes from negative 29.9 to positive 2.2%. So my big first message, the first lesson that I want everyone to think about when you think about diversifying your portfolio with just diversified stocks and diversified bonds, and I'll get into it in a second, is think about your time horizon. There's no such thing as a perfect investment. There's no such thing as a perfect asset allocation. There is only the perfect investment and asset allocation for you and your family and your goals. So when you're at home looking at this chart and you're thinking about things, think about your own portfolio, talk to your own financial advisor about it, but always think about potentially the worst case scenarios. Think about how much money you'd like to make, but always thinking about the downside risk. So if you have a 5-year time horizon, you can think more conservatively. All right. Now I've talked about stocks, but let's touch on bonds, because if you have a high stock position, especially a single company, usually, and this year's been a little bit different, but usually, and probably throughout the rest of our lives, bonds will be a good diversifier. Just because they're not the perfect diversifier all the time doesn't mean they're not most of the time. So bonds do a couple things, several things for us. The 3 big reasons that we hold bonds. We hold bonds for income generation, we hold bonds for equity diversification, and capital preservation. Now, I know all of you are very savvy on the phone, and there's lots of different kinds of bonds out there, to include things that are referred to as high yield bonds, sometimes referred to as junk bonds, which aren't very high quality. For today, right now, we're only going to be talking about high quality government bonds. So high quality bonds. They aren't as exciting, but they don't default, or at least not usually. All right, so why do we care? Let's talk about it. This is a chart that goes back to 1950, and it shows every single down year in the S&P 500. And then it shows you what bonds did in those years. Now we're living through a very weird time right now where stocks and bonds went down together, but I just want to show you, at least over the last 70 years, that's not usually the case. So what we've seen here is that the only other time in history over the last 70 years where stocks and bonds went down at the same time together was in 1969. We'll probably see it again in 2022, but that's not usual. Also, if there's a recession as we move into 2023 and the economy comes under pressure, bonds will most likely, our high quality government bonds will most likely hold up and do well. So it's just another thing to think about. When the economy gets difficult and people are worried about, when people are losing their jobs or they're worried about losing their jobs, high quality government bonds can be one of the best diversifiers out there. So it's something that you should all consider talking to your financial advisor about and consider putting in your portfolio. Now, I do want to say, everyone here is different. I don't know you all individually. Every single one of you is going to have different goals, different circumstances. So I would highly encourage you, as we go through this and I talk about different diversifiers, you can think about it. You should do your own research, but you'd also reach out to a professional financial advisor, ask for help coming up with a good plan. All right, let's talk about today. Today, right now, what's going on? The bond market has not done well so far this year, but there has been a silver lining. And that is, as the Federal Reserve and other central banks around the world have been raising rates, if you now were to go out and buy bonds, you can get really good incomes from the bonds that you are buying. Now, many of you have retirement accounts. So in retirement accounts, you can look at taxable bonds. Taxable bonds, Bloomberg aggregate, as of September 30th, paying 4.75%. If you look at your personal accounts, high quality investment grade municipal bonds, so state and local government bonds, these are double tax-free bonds paying over 4%. So double tax-free income for you in a high tax bracket of 4% is really outstanding. And if we head into tough economic times next year, these bonds should hold up very, very well. So point number one, if you're looking to diversify, you should first diversify your equity holdings. We'll talk about that later, but also take a look at a really good, in your personal account when you're paying taxes, a really good municipal bond strategy. It can help you quite a bit. Now, we're about to get into, we've talked about stocks, we've talked about bonds. I'm about to jump into real assets and other things. But before we do that, I like to keep it interactive. Let me pause and see, are there any questions right now? Are there any questions about diversified stocks, muni bonds, government bonds, how we diversify just those two before we go on to the next section and we talk about other things to add into your portfolio? And I'm not sure if we want to unmute, if people want to talk, if people share in the chat. What is this an alternative to? I see one question. So, too late to do redistribution to 60-40. It's never too late to do a redistribution. It really depends on your particular situation. So we're going to be getting into more alternatives, but you know, everyone's situation is different. So I'm assuming that many of you, or some of you, what I've hold just one or two different companies, or maybe you hold an S&P 500 ETF. If you want to think about diversification, high quality government bonds are going to be a great diversifier to either your single company concentration, or it can be a diversifier to the S&P 500 if you hold an S&P 500 ETF. It's also not too late to change to 60-40, but 60-40 may not be right for you. So you should definitely consult with a financial advisor before you do that. All right, I will keep these questions open. As any of you have more questions, please just type them in, or I'm not sure if other times we may go off mute and start chatting. Okay, let's talk about other alternatives. And I'll close this really quickly. Oh, Dave raised a hand. I don't know if Dave has a question or if he wants to type it in. And Junia, I may not be able to see all the chats at all times. So if there's anything popping up in the chat window, please let me know.
Don't worry,
Oh,
I will.
perfect. Okay. Real estate. I get a lot of questions about real estate. Real estate can be. Can you hear me okay? Very good. I'm getting someone's. All right. So real estate investment trusts. Real estate investment trusts are things that you can invest in. They are publicly traded securities. You can invest in them on the stock market. They have daily liquidity. This is a public instrument, something that's trading that it's investing in real estate. If we look back here to all the way to 1972, REITs have done quite well. They have equity-like returns. So equity-like returns returned 12% versus 11.2% for the S&P 500. So over this time period, actually outperformed the S&P 500 slightly. They also delivered quite a bit of income. So 61% of that total return was income. The other thing, when we think about diversification and correlation, is that if we look at it to the overall stock market, REITs had a correlation of 0.59, but a very low correlation to bonds of 0.17 over this time period. Volatility, which we should be aware of, so this is the risk on any given year up and down, volatility has been higher. So that's also something that we should think about. But if you're looking at, if you own your single company, if you also own a diversified pool of stocks, you've now added in some bonds and you're looking for other things to potentially invest in to add some more diversification, REITs can be quite a good diversifier. The other thing that's nice about REITs is because they have a concentration on dividends and income, is that if you're in the tech industry, it also tends to have a lower correlation to tech if you're investing in REITs all throughout the United States. Some people will bring up REITs as a good inflation hedge, and I do not recommend that. The correlation with inflation has been negative 0.02%, so you should not think of REITs as an inflation hedge. They're a good investment. They tend to outpace inflation, but that doesn't necessarily mean they will hedge you against higher inflation. But they are a good diversifier. So if you're looking for 3 potential things in your portfolio, you can start with diversified stocks, government bonds, and REITs. I'm going to skip this. Actually, I'll touch on this really briefly. I'm not going to spend a lot of time, but MLPs, master limited partnerships. This is the energy sector. These are oil. These are pipelines that bring either oil, natural gas. You can also invest in these through exchange traded notes. They tend to pay a lot of income. They are an uncorrelated asset, but the thing to understand is that they can be wildly volatile. So if you're looking for some energy exposure that's a little bit different than most people, you can take a look at some funds that invest in MLPs. You can also invest in MLPs directly, but they tend to have very complicated tax reporting. They can potentially lock you up. So I would recommend, there's a lot of good companies out there with good funds. Do your own research, check Morningstar, but there are exchange traded notes and funds that do MLPs. Now, gold. Here's another thing. Of course, we cannot talk about a diversifier without talking about the precious metals. And the most precious metal of it all, at least as far as investing, is people bring up gold all the time. Gold can be a diversifier. The one thing that I like to warn people against is that sometimes people get interested in investing in gold and they put too much of their assets into gold. Now, gold can be a great diversifier when times are bad, but most of the time, you are better off investing in stocks and bonds. So let's just talk about, if you're going to use gold as a percentage of your investments, here's the things that you should know about it. This is going all the way back to 1970. It is a tail risk hedge, meaning if the market crashes and something really bad happens, like a global pandemic or a war, gold tends to do well. On the other side, if there is extremely high inflation that comes out of nowhere and surprises everyone, gold in those scenarios also tends to do well. I'll show you that in a second. But everything in the middle, gold doesn't really do much. So it protects you on extreme events. So let's just talk about the downside. When, in general, the markets go down, gold tends to protect. So if the market drops by 20% or more throughout these last 52 years, gold has done quite well. When the market has dropped 10 to 20%, gold also did quite well, returned more than 10%. As we get to 0 to 10%, it's a whole lot less. But in general, when the market's dropped and has turned negative over these last 52 years, gold on average returned 9.2%, adjusted for inflation. So gold can be protective when the market goes down. But the other big thing to note here is the volatility and the risk. On any given year, gold can be wildly volatile. So if you do invest in gold, or if it is something you're considering about, definitely talk to a financial advisor. And I recommend doing it in small amounts. Do not put all of your wealth in gold. Now let's get into what we do think would be a good actual inflation hedge. And that is more a diversified group of commodities. For those of you who are worried that inflation may be higher for longer, and we may see inflationary numbers that are higher than everyone else is anticipating, investing in commodities can be a way to deal with that. So what we have here, again, 52 years of data going back to 1970, lots of data here for you. And this is looking at inflation. We have inflation below 0%. We have inflation between 0 and 2%, inflation between 2 to 3, 3 to 4, 4 to 6, and then above 6. We have commodities, gold, the equity markets, and taxable bonds. So let's talk about this. When inflation is below 0%, commodities tend to do the worst. They turn negative. When inflation is between 0 and 2%, like it was for the 10 years before the pandemic, also, commodities do not do well. They fall down. But as we start moving above 2%, it tends to be a little bit different. So, pardon me. When inflation rises above 2%, commodities start giving a decent return. However, if you compare that to the equity markets, like I said, owning equities tends to do better. Owning equities will do better when things are below 0. Equities will do better when inflation is between 0 and 2, 2 to 3, and even 3 to 4. So pretty much everything where inflation is up to 4%, the equity markets tend to outperform. And commodities do okay. It's when inflation moves above 4% that we start to see the role of commodities. Now remember, the Federal Reserve target for inflation is 2%. So this means inflation is running double what the Fed target is. So adding in a diversified pool of commodities, again, there's a lot of good funds out there. Talk to your financial advisor. But when inflation runs above 4%, commodities tend to outperform. They outperform stocks, they outperform bonds, and they outperform gold. And as we move up to above 6%, commodities still outperform stocks and bonds. And this is where we really see that when we talked about a tail hedge, gold does well if it is incredibly a surprise inflation number to the upside. People tend to panic and rush into gold, at least they have in the past. And this is what we've seen over the last 52 years. So gold does well here, gold does well here, but everything else, most of the time, stocks and bonds are really going to be the best thing. As inflation runs above 4%, adding in commodities can do well, very well as well. And real estate is also something you can think about. Just to put some numbers here, if you're thinking about commodities, at least over the last, call it 50 years, how often did it benefit? When did it detract? Well, just because we haven't been in a really horrible inflationary environment, at least over these last 50 years, adding in commodities was basically, it didn't do much 64% of the time, but it did protect 36% of the time. When it did protect, it outperformed. So this is what we're seeing. I think this is a good place now for me to stop and take some more questions. I've got some financial planning basics, which I promised to talk about in the last couple minutes, but I just want to make sure if there's any questions of things we can do. I haven't seen any more, but big diversifiers we talked about. We want to diversify our stock portfolio, number one, if you just have one or two companies. Then you want to think about adding in government bonds. That's going to be your best diversifier. Next thing on your list should be real estate. And it's really easy if you're investing in REITs, publicly traded REITs. That's a great way to get exposure to the real estate market. We can think about gold, but we can also think about commodities. So these are all things that we can put into our portfolio. They will perform well at certain times and not well at certain times. But the whole point is that when certain parts of the market aren't doing well, other parts will be doing better. So you mix all of these things together for a portfolio that will protect you no matter what happens.
And I kind of want to add on to a footnote here that I've seen cases where clients own quite a bit of real estate, real houses and residential and commercial real estate properties. Adding real estate investment trust into their portfolio might have an overweight into that sector. So be careful, because with the rising interest rate, it might give a little impact to your portfolio performance.
Absolutely. If you already, so real estate, you can do it publicly, but maybe you already own some properties already. That should be considered real estate. So you want to always, that's why I always recommend talking to an advisor. Everyone here on the call is different. Think about your entire portfolio. How much do you have in your single company? How much do you have in the overall stock market? How much do you have in bonds? How much do you have in real estate, whether it's a house that you own or real estate investment trusts? Then how much in gold? How much in commodities, how much in other things. You want to have a good blend all together. You are all different, so you should all think about putting it together in slightly different ways depending on your goals.
Ed, we have two questions here.
Please.
Greenie Van Buren asks, will stocks become a better long-term investments if they are in the strategic important area?
Absolutely. So I don't think anything does better than profitable companies. So, if you find companies, and again, there's even a single great company can fail, but if you're investing in a diversified pool of stocks in really good areas that are profitable, a lot of them pay dividends over the long term, that's going to be your best bet. So if you're a long-term investor and you're not worried about volatility, profitable companies are almost always going to be the best bet. At least historically speaking, they have been. What kind of commodities? I recommend a diversified pool. So I don't recommend picking and choosing wheat over sugar or over corn. There's a lot of good ones. The Bloomberg has a commodity index, and there's a lot of different tools to invest in that. There's mutual funds. There are ETFs. There's a lot of highly rated ones out there. You should take a look. Again, consult with your financial advisor. You can use Morningstar to find good ones. There are a number of good ones, but don't pick one commodity. Invest in a diversified pool of commodities. All right, please feel free to ask more questions as we go. I want to highlight a couple of other things. Energy is absolutely can be considered a commodity. I touched on MLPs. Blackstone does have REITs. So Blackstone is a large investment firm. They have hedge funds. They have something called a B REIT. Blackstone does do REITs, but they do other things as well. So that is one of the company that puts REITs together. On the financial planning basics, one of the things that I like to bring up to wealthy individuals, so everyone's different, but within your companies, you should have a 401k, a traditional 401k, and a Roth or a Roth 401k or a Roth IRA. Now, many people, if you're in a high tax bracket, will do the traditional 401k so you can write off your taxes. But one of the things to consider is if you think you're going to be incredibly wealthy, meaning you have a company where you're just making a lot of money and outside of your 401k, you have a lot of wealth that you are accumulating, which you'll be able to live on in retirement. If you don't think you're going to have to dip into your retirement account till later, if you have other assets, it may make sense, and again, consult your financial advisor, it may make sense to put your money into a Roth IRA, meaning paying taxes now and letting it accumulate. The reason for that is that there's no required minimum distribution ever on a Roth, which means if you have extra money, if you're putting money towards your retirement in other places, you can draw on that in your 60s, in your 70s, not touch your Roth until you're 80 or 90, or maybe never touch your Roth and pass it off to your children in the next generation. So if you're to the point where you're maxing out your 401k, but you also have other assets and other wealth that you're accumulating, for many people in that situation, a Roth 401k may make more sense. You can accumulate more wealth into your 70s, 80s, and 90s and pass more wealth off to your children. Again, talk to your financial advisor about this. The other thing when it comes to, and I'll pass, these are just some things to consider. I will share it with you later. Other big thing I like to tell everyone, for those of you who are not, if you have young children and you haven't set this up, every single one of you, set up a 529 account. 529 accounts are places where you can put money You can add in money for your children to go to college. You can invest it, and it will grow tax-free. So everyone should open up a 529 account. And the other big benefit, you're going to want to talk to your advisor or accountant about this. You could do accelerated gifting in a 529, meaning there's usually a limit of $16,000 a year, but you can put in 5 years immediately. So 16,000 times 5, if you have the money when your child is young or a baby, and it will just grow and grow and grow tax-free their entire life. Now, the one downside is that you do have to use this on education. So this is money that you're putting in for your child, and it has to be used on education. Now, the good news is that if you have 2 or 3 children and you are the trustee, you can always transfer it to another child or another relative. So there is some transfer. Talk to your advisor. I won't get into all the intricacies today, but money that you put in gets to grow tax-free, but it has to be spent on education.
You may also use it for yourself.
You can also use it for yourself or your spouse. Lots of people in your family.
Yes, 529 can pay for student loans. Sorry, I take it back. That's a very tricky question. I have not seen people paying $529 dollar amount to offset their student loan so far. Yeah, what do you think?
I'd have to. We'd want to talk to a tax professional about that.
Yeah.
That one I haven't seen, because usually when people set up 529s, it's going to be for college in the future, 5 years from now, 10 years from now, 15 years from now, not something that's happening right now. All right, so I'm going to stop sharing for 1 second. I'm going to share one more screen. But oh, here it is. So I wanted to give you all an example. I talked about diversifying your stock portfolios. I said that's one of the best things you can do in the beginning, and there's a lot of great strategies out there. I want to show you an example because we're here from Capital Group, and I'll just show you one idea because a lot of you are in tech. I just want to show you one of the ETFs that we have that actually has less tech exposure than most of our other investments. So if you already have a lot of investments in tech, this is a diversified ETF. It holds 48 different companies, but it leans more in large value and it focuses on dividend. So it's the strategy within this ETF is that it looks for value in companies, it seeks income, so dividends. And I think probably the biggest thing, really, really high quality companies, well-established US companies with a history of financial strength, regular dividend payments. So on September 30th, the dividend was a little over 2%. It's an ETF CGDV. It's focused on the US. I just want to show you the top holdings here. So, we have Microsoft at the top, but then we have Raytheon, Broadcom, Philip Morris, General Electric, different things. And then as we go down, we can actually just look at the different sectors and we can see how much. I know a lot of you are in tech, so 15% is in the tech sector, but we have over 20% in industrials, 15% in healthcare, 9.3% consumer discretionary, and other things along the way. So I just wanted to show you all one very specific example, at least a Capital Group, of how we like to diversify. This is an actively managed strategy. Every single one of these companies has analysts covering it, portfolio managers choosing it. And again, it's 48 different companies with the way to diversify. Again, I'll send you this as an example. All of the disclosures are here, but I didn't want to get off the call with you with at least giving you one example of how you might diversify your equity strategies. There's lots of ways to do it. I've heard before that you've had a lot of people come on and talk to you about the S&P 500 ETFs. Those are certainly fantastic and one great way to diversify. Here's another that's actively managed.
Ed, there's a question about, can you tell us which sectors of the market went up when the tech sector went down?
There's a great, I didn't bring that slide with me, but how about that? I will tell you that during the last downturn, during the last 8 downturns, the sectors that held up the best were healthcare, utilities, and there was one other that I can look for. I'm forgetting it right now, but healthcare and utilities are the two sectors that Capital Group has been focusing on during the downturn as being very, very protective, but also with fantastic investment opportunities.
There's another question about the recent restrictions on the redemption from the Blackstone REIT. Can you talk to us about that?
So I'm not an expert in Blackstone, so I can't give you specifics in Blackstone. I just know that Blackstone has REITs. There's other REITs out there. Blackstone, I believe, does a private REIT, so there are liquidity restrictions. There's Vanguard and Fidelity that have completely publicly traded REITs, so they have daily liquidity. Again, don't invest in anything until you talk to your financial advisor, just to make sure that it's the right investment for you. But Blackstone tends to do illiquid private REITs that do have liquidity constraints.
To answer the question about 529, there's actually a legislation signed by our former president to be able to use a lifetime limit of $10,000 to pay off your student loan or your beneficiary student loan. You can use that $10,000 lifetime limit.
Mm-hmm.
But talk to your financial advisors or your CPA for that matter.
The expense ratio of the ETF that let me look for it really quickly.
0.3, I believe.
Yeah, it's 33 basis points. It's an actively managed strategy with 33 basis points expense ratio. And again, I just wanted to come with one recommendation. Capital Group has dozens of mutual funds. We now have, I think, 11 or 12 actively managed ETFs. I just wanted to come with one example, and that's the equity strategy. That's the equity strategy ETF that has the least amount of exposure to tech.
I do have other questions that I was asked by other clients of ours. What should we focus on? What kind of themes should we be focusing on in 2023 if we were to have recession? What do you think, Ed?
Well, as I mentioned, I think during an economic downturn, if we look at history, there's no promise about what's going to happen in the future, but with history, high quality investment grade government bonds tend to hold up the best. So if you are worried about a recession, think about high quality California municipal bonds or United States government bonds. These can all be great ways to have something very protective in your portfolio. And of course, the other one is, just high quality stocks that are paying dividends. They tend to be they're obviously be more volatile than bonds, but they will hold up. If they go down in the short term, they do tend to rebound quickly and they will hold up better. Junior, we are at 6:30. I want to make sure we're staying honest on time here.
Well,
is there anything that I have missed or any other things that I should try to answer?
Well, let me do a quick recap of what you just showed us today. You talked about diversification on the portfolio, the importance of that, and how do we go about doing that, and why should we do that, right? You talked about the role of bonds. What are they? They're more so for income generation, diversification of stocks, and also capital preservation. So we got to know, why do we want to own bonds in our portfolio? And then you talked about the potential for bond yields. As we go higher and higher on the bond yield, it might benefit us on higher income than what we can look for in the cash management accounts. You talked about other types of alternative investing. You talked about the real estate investment trust as an option. You also talked about the master limited partnership, which is in energy and oil and gas. You talked about using gold as protection when inflation goes really high. You talked about the commodities, which can be also another inflation protection or hedge. Lastly, you talked about financial planning basics. How do we use retirement savings like 401k, Roth IRA, Roth 401k, or traditional IRA to save up more money for our future generations or our retirements, right? And you also talked about 529, how important that is. And it is very frequently used nowadays for a lot of the kids out there because college becomes more and more expensive, and that can be a very good tax saving strategy. JP, Jonathan, I will open up for you guys to talk about what we were missing. And just be aware, this might be a pilot 101. We might come up with a 102 session as a continuation of our topics today.
Yeah,
JP
yeah,
and
yeah.
Jonathan, I'll turn it back to you.
Thank you. You cover a lot and very impressive. So a question just came in. I think you probably see that and asked about annuity insurance. I think just another one. People tend to, some young people, I feel, very much like the digital cryptocurrency. And we did not cover those three areas. But you did touch every other sector. So it's a good talk, and I really appreciate it. It opened a lot of options. So we need to think hard what's the best for us. I think the best to do is we open up to question and answer. But before that, you want to briefly show your contact information, briefly give you 2 minutes, 5 minutes to talk about Capital Group before we open up to.
Thank you so much for letting us do a little marketing here. Capital Group is actually one of the largest active money manager in the US. We have $2.3 trillion under our management. We might be the biggest firm that you have never heard about, but you own it in your accounts. We are the parents to American Funds. American Funds is one of the oldest mutual fund in the US. And we own our investment research. That's why we're very good at it. And we use those research globally and locally to support our investment ideas. We don't sell it, so we are very private about it. And we're very proud owning our investment research, supporting our ideas. At Gonzalez, and my name is Junia Pandy, we are the liaison, the connection between our portfolio managers and our analysts in Capital Group, and to our clients, so that we're here to answer any questions, to give you plannings, and to lay out some options for you to consider, because everyone is different and their financial situation is different, the tax bracket is very different, and their need and the goals very different. So talk to your financial advisor about what your goals are, how you would never run out of money, and how can your money help you instead of be a trouble for you. So that's all I have to say.
Okay, I appreciate it. So we also can talk to you too, is that right? So if any one of us like you, and you will share your contact information in the presentation we're distributing?
Yes, I will, JP, Jonathan, I will send you the presentation that Ed Gonzalez has showed us today. That's very useful, and it's approved, so I can send it to you so that you can distribute it to your audience.
Okay, thank you. Now, so with that, we should open up for Q&A before we wrap it up. But before we wrap it up, I really want to, on behalf of CIE, appreciate your openness as a research. The data, the chart and graph, it took a lot of time to gather. So you managed to present that in a short period of time that it would take us a lot of time to digest. Yeah. Okay, everybody.
My pleasure.
Thank you. Any question you want to add, Junia and Ed?
I just want to thank you for your support as always, and I look actually forward to our webinar 102. And we ought to talk about annuities and life insurance, how we can use that as also another way of alternative investing, and also, if we do have a chance, we can talk about currency, right?
Yeah,
yeah.
We can have a whole presentation just on cryptocurrencies.
Yeah, and then there's some people doing oil trading, right? Yeah, there's so many different kinds. But do you count the oil trading as a part of the commodity, or buying oil is a totally different subject? Trading oil.
Like trading oil futures, you mean?
Mm-hmm.
I mean, that's definitely commodity investing. I'd say trading oil futures can be very, very risky because you're usually doing that with leverage. But that's commodities. Yeah, that's commodities trading.
Oh, okay. Okay. I heard a lot of people in Hong Kong doing that because Hong Kong is a free trade center. The oil in and out China through some black markets. There's a lot of people trading oil future over there.
I mean, this year, the energy market has been doing incredibly well, so that doesn't surprise me. It can be very, very lucrative, but again, when you apply leverage to things, they can increase the risk dramatically. So trading in oil's futures, you can do it, but it can be very, very risky.
Okay.
I think in this presentation, Ed and I didn't talk about private equities. Private equities might be another option for a lot of folks to consider, especially here in the Silicon Valley. But this is something that, is also open up only for qualified investors. So something that you can consult with your advisors on together with ETFs. I know, ETF might be another session that we can talk about for 1 hour and so. So ETF is a broad market and there's so many ETFs out there. How can we look for the best that suit you the most? That's something that we can talk about. And if you do have questions, ask your financial advisors, or you can contact us and we can guide you through what ETFs are good.
Okay. Any other questions?
And maybe I can just do some marketing out here. Maybe Ed, you can help me do that. Our ETFs have been newly released, and that has already attracted a lot of traction about what we do in our ETF funds, right?
Yes, I mean, so we launched these ETFs back in February, and I believe CG Go, which is our global growth ETF, is now the largest global actively managed ETF in existence. And I think that our US strategy is the second largest actively managed ETF in existence, if I have my numbers correct. So they have been incredibly popular for those of you who are looking for actively managed strategies where you have analysts and portfolio managers making decisions. They might make a lot of sense for you, and they certainly are great diversifiers. And we have mutual funds that have been around since 1933. So Capital Group has been doing this quite a long time.
Okay. Maybe I can take ask another question, and then we can close it up. The year end's coming, so by the year end, what should we do about it? And at the beginning of next year, what should we do about it? Let me elaborate a little bit about my question. Usually in year end, we kind of write it off for the loss or sell it if you want to take profit this year and sell it, or reposition your portfolio for next year. That kind of stuff. What do we need to do? And then at the beginning of the year, usually like many years, the beginning of the year, maybe a week or 2 weeks, always upturn because people and fund manager kind of positioning their portfolio, they're buying. So with this situation, we have receptions is high. You think it will happen like what we have in the past, or what should we do? What should we prepare for year end and coming 2023?
Let me answer that first of all. I think that you should definitely work with your advisors to talk about how should you actively reposition your portfolio based on your goals and objectives. How do you benefit from tax loss harvesting so that you are either not paying too much tax at the year end, or you can benefit from the reallocation of that front? Talk to your tax advisor on that and your financial advisors. There are some rules and regulations changing in 2023. This is something that I am very passionate about when it comes to estate planning, because making more money is great. It is just a tool to make you live better. But if you don't save it, what is the point? So estate planning is really important, and that is something that I talk about all the time. I will let JP and Jonathan know about my next session about estate planning, which I can invite my estate lawyers, in-house lawyers, to talk about ways that you can think about or talk to your attorneys about saving on tax money. How can you transfer wealth to the next generations? Things like that. So those are very important point for you to consider. And
Okay.
I'll let Ed add on to it.
No, I think the most important part, because everyone's different, talk to your advisor. And if you don't have an advisor, call Junia. She's fantastic.
Okay, we will. Hey, anybody? Without any other further question coming in, we would like to thank Junia and give us all the insight and let us pick their brain for tonight. And we get a lot of help and input.
And just to answer the last question there, the CG ETFs are publicly traded. So if you have a Fidelity account, Vanguard, any of the ones that trade, you can find Capital Group ETFs on there. Yes, they are publicly traded.
Okay, and King Lu just have a last question came in.
Self-directed IRA customers. I mean, we have our, we have our ETFs that are available. But if you need planning help, advisor or reach out to Junia.
Cool. With that, I would like to thank Junia and F for tonight for the talk. It's a wonderful talk. Jonathan, you have anything else you want to say, or Brian?
No, the same. Just want to thank Junia and Ed and all the provided so informative information to all our members. Thank you so much.
My pleasure.
I want to say thank you and have a happy holiday. Be warm and cozy at home, and I'll see you next year, and have a really great 2023.
Have a wonderful, wonderful new year.
Thank you. With
Thank
this,
you so much.
We'd like to wrap up the webinar tonight. Thank you, and we can stop the recording. Okay, thanks.